Welcome, everyone. Today I'll be talking to a close friend, Colin Vergilio, learning about his career, academic background, and the industry of venture capital. Colin and I met in college when we were both on the rowing team together. He majored in business management with a couple of concentrations, I think finance, accounting, and information systems. Is that right?
Yes.
All right. Colin worked on the student e-board for the Shea Center, which was the primary entrepreneurship organization on our college's campus. After graduation, Colin worked at an investment banking firm for about 2 years, and then worked at a venture capital firm for about 3 years, all of that post-graduation. Colin has 2 cats, Captain and Luna. He grew up in New Jersey, and I would say he is squarely in the top 1% of the world in net fishing. All right, anything else crucial in your background I may have missed?
I think that's pretty much it. Appreciate the kind intro. I would say Alex is probably giving me a little too much credit on the net fishing, and honestly, if we're going to be intellectually honest here, I don't think you actually have any stats to back that up, but just want to make sure we're being honest with our listeners here.
I don't, but I don't think 99 out of 100 people could catch one fish in a net.
So we're talking about not of net fishers. We're talking about pick a random person off the street and tell them.
Everyone.
Okay, I'll take that.
All right, great. Okay, so tell us a little bit about when you first learned about finance career paths.
Yeah, I think it's very easy to go backwards and try to draw things in a straight line, but it actually was pretty all over the place to start off with. I was always interested in businesses and just entrepreneurial pursuits from a young age. I was the kid that was selling candy in the hallways. I used to always go fishing, would sell fish to a local bait shop. I actually didn't have a lot of traditional jobs lined up when I was younger in high school. It was always some sort of a gimmick or little business that I pulled together to really. So my main job in high school was I was a landscaper. So I started off just cutting lawns and realized there was a lot more money if I was going to go into mulching, trimming bushes, the other stuff around it. Figured out that I had a reasonably good audience with Facebook pages. And so that was probably where I realized just how valuable some of these skills could be. And there were a lot of classes in school that lined up with that interest. I was lucky. I went to public school, but it was a big public school. So there were a lot of electives to choose from and learn about various just aspects of business. So the first one I actually got involved with was accounting. The reason I took accounting was candidly because my older brother had taken it and he said, there's 4 years of accounting classes at Watchung Hills, and so you should start now. And so I did. I came off the bat and jumped into accounting, and I naturally just found myself really leaning into it. It came very naturally, and so it struck me as something that I wanted to at least learn more about and dig deeper into. And that kind of started my march down the finance career path, at least in high school.
Was that a big focus of high school? Did you have a lot of people in those classes, or how did that work for you?
There were a few classes. There were about 3 for the entry level accounting, and then as you got deeper and deeper into it, there were fewer and fewer. There was an international finance class, a generalized business management class, a whole lot of others that I'm probably forgetting, but I knew that I was at least interested in the finance and business aspects of what potential career path could come from that. And I ended up taking every single business elective that I could get my hands on at in high school, at least. And that very much informed what I wanted to do for undergrad. It's funny, even after all those classes, I still didn't fully understand what would come from a business school education, or kind of what the world of the possible in terms of the different areas of business and what I could dig deeper into in college was. I actually went into college thinking that I was definitely going to be an accountant because that's what I took the most classes of in high school. And so that's, you mentioned at the top that I had the accounting concentration. That's where that accounting concentration came from in the first place.
Did you start with that? Was that your focus to start with then?
I started with finance and accounting. And from there, I added on information systems, and I ended up taking a whole bunch of classes in entrepreneurship as well. But from the start, I was interested in accounting. Realized pretty quickly that I was more interested in accounting for what it can do for a business and just how it lets you read financial statements as opposed to being an accountant myself.
Did you prioritize any others besides the accounting, or how'd that go?
There were a lot. International finance was one that was pretty interesting. Like I mentioned, business management was one that was very generalized, but hits on like the high level of how does business actually work and how do you go about the operations and how to dig deeper into why some businesses fail and why others succeed, which I've always found very interesting. What makes a viable business? What does a good business model look like? And how do you keep that going over a long period of time as opposed to, what I learned from middle school, high school is like selling candy in the hallway. That's a fun gimmick for a short period of time, but eventually your market runs out. You can't sell Starburst forever. Eventually you need to mature a little bit and find some, more sustainable ways to have a business. So that was like the start of the journey. Again, I said like going backwards, it's easy to draw a straight line and like realize that that's what I was learning at the time. I think that's something that I learned way later. There was a lot of fumbling to kind of get to exactly what I wanted out of a business school education. But I did know from all those classes that there was something interesting there. There was some kernel of the more I learned, the more I realized I didn't know.
Yeah.
And I wanted to pursue that. So that very much narrowed my selection of colleges. There are undergraduate business programs out there, but far fewer than there are just general liberal arts programs.
So then kind of going to college a little bit, when do you think you'd say you started straying from the accounting path? When did you start to go a little more into finance and entrepreneurship and making those decisions?
Finance was the natural adjacency, but I think what made me realize what else was out there quickly was it was called computers and management, but really the best way to think about it is just a strategy class with elements of tech mixed in. And I found that incredibly interesting. The high level of what we would spend our day to day on was digging into different business models and why they were able to disrupt, call it the status quo, and build a new large enduring business in what had otherwise been considered a mature space. And so an example of that would be, think about Netflix, why Netflix was successful, why Blockbuster failed. Was there something structural there? Was it the people? Was it the business model, the world changing underneath? That was something that was incredibly fascinating to me, especially since most people look at Netflix and they assume, oh, well, streaming killed Blockbuster. But Blockbuster was actually dead before streaming.
Really? I didn't know about that.
Yeah. It was what actually killed Blockbuster was not streaming, but it was Netflix's subscription business. And if you remember, they had all those
DVDs, right?
For all the dinosaurs out there, they were actually shipping DVDs.
I totally forgot about that.
To individuals first, and that's where the CEO and founder Reed Hastings originally realized that Blockbuster had this vulnerability. It's actually the advent of the internet and the idea that consumers could browse, look through movies, click through a catalog, combined with the smaller, slimmer nature of DVDs, where it was cheaper to ship them. Those two together opened up a window for Netflix to step away from brick and mortar. And so it was the warehouse distribution model of people subscribe, get unlimited access to movies.
Right. Were people ordering the DVDs, or were they just getting random DVDs every month?
They were ordering. So this was also a massive part of Netflix was the interface that they built. Okay. And we take it for granted today of, my algorithm on Netflix.
Of course you can scroll through your phone to pull up a video you want. Yeah.
Yeah, but they were able to figure out how to put the long tail of DVDs in front of consumers that they would want, that they might be more interested in based on what they had rented previously and how they rated it.
Yeah.
And really introduce movie watchers to a subset of movies they had never really had access to before. They'll call it the long tail. And they were able to support that long tail because of their warehouse distribution model. You have one DVD of this random niche cult, like...
Yeah.
Basically, you could have a single DVD that, only 5 people would ever watch, but the cost of keeping that was the $20 to buy the disc in the first place and just have it on your shelf, as opposed to Blockbuster needed to pay, think of it as rent to actually keep that DVD on the shelf. Netflix ultimately had unlimited space to offer that long tail of movies that ended up being far more interesting to consumers, and the stability that a subscription business model offered as well, and just a lot of other structural advantages that let them beat Blockbuster. Had nothing to do with streaming. And so Blockbuster was already dead before streaming came into the picture. Netflix had successfully disrupted them without what we assume, going backwards, is this technological paradigm shift that made them obsolete.
Which again seems so obvious in hindsight. Like I can't imagine being... My family didn't get any sort of Netflix or streaming apps until probably 2015, 2016. I can't imagine in 2009 being on neopets.com and then switching to a Netflix application to pull up any video I want. Like that, those just seem like such different worlds.
Yeah, and it wasn't. You had to order your DVD. It would come in a few days, and it was this idea of skating in front of the puck, where the puck's going instead of where it was. And they found themselves in the right place at the right time. And, of course, in retrospect, it's the business model that was perfect for a world where streaming exists, where your cost of delivering that movie to the end user is next to nothing. But it was always heading in that direction, and Netflix just got there first, while Blockbuster got caught flat-footed. So, a long aside, but that sort of thing interested me.
So, at what point in that college, not only your college education, but also like learning about some of these specific business cases, at what point along that line did you start getting involved with the Shea Center for Entrepreneurship and really nurture that? Really start to scratch that itch of business and entrepreneurship stuff?
Yeah, so that happened my sophomore year, and that was after my freshman year computers and management class. I realized, hey, like this is very much something that I'd like to pursue and learn more about. I think it became clear to me that, there were a lot of organizations on campus that you can spend time with. And obviously, Alex, I spent the vast majority of my time with the rowing team. But beyond that, I think the thing that interested me the most about the Shea Center was the opportunity to work with students at that formation stage. And that was what went behind a lot of the actual programming of what the Shea Center offered. So a little bit more depth on kind of what the Shea Center did. The big one was the venture competition. That was at the end of every year, and students would come in with a full business plan for a proposed startup. It'd be questions and answers, digging into the business plan, viability, and there was significant resources available for the winner. I think it was on the order of magnitude of tens of thousands of dollars. And
that's right.
The prize money has shifted over the years, and I think it's actually gotten bigger, but there was, a lot at stake for these student startups, and some of the businesses that came out of it, I mean, they became real businesses. It's really fascinating to look back and see things that students might not have even taken fully seriously themselves became fully fledged businesses that still exist out there today. And that was something that was really cool to see from at least the e-board seat. So essentially what we would do is there is an elevator pitch competition, this venture competition. We actually had an accelerator as well, but the whole aim of the programming was to provide students a platform where it was natural and easy to actually start that business and explore entrepreneurship and do that in a low friction, no risk way, and have access to the resources or at least thought processes necessary to start to develop that interest in entrepreneurship. So really, really enjoyed that. It was really cool to see. What I didn't realize, and again, the theme of, it seems obvious in retrospect when you have the benefit of hindsight, but the seat that I was sitting in for the student e-board was very much like a VC seat of you're helping run this programming. You're trying to draw the bar of, what level of seriousness do you need for students to be involved, to have access to these resources. You want it to be low friction, but you want to make sure that there's commitment on the front end. And think about, where should we be allocating these resources?
Fantastic. Okay. So I think it'd be really interesting to kind of hear from your perspective what VC is, what are its goals, a little bit of the intricacies of how it works. I would personally compare venture capital to something like Shark Tank, where a firm, a person or a company makes a bunch of little investments and hope a few of them blow up, and 100 times or 1,000 times your return, meaning a bunch of the rest can fail, and the companies still come out far ahead compared with public investments. Yeah, I want to get your perspective on that and any corrections you might make.
So I think you're absolutely right in terms of how VCs today think about portfolio construction and how the business model itself is viable. I think the best way to think about why VC exists in the form that it does today is to think of it from the individual company first. You look at VC-funded businesses, and essentially what VC is trying to do is find an idea, a business model, where there's this enormous amount of potential to deliver something, a paradigm-shifting business, right? Something that will take a large market where there are existing incumbents, sometimes a lot of spend, sometimes that spend is growing, but there's opportunity. There's this market opportunity. And the cost up front to get there would otherwise be a barrier to these new, young, smaller businesses existing. And it's a very high risk proposition of, hey, you're going to take something where there is nothing, you're going to put a lot of resources into that, and hopefully that allows you to take on Goliath. And what VC does is take on that risk, give the resources necessary to the entrepreneur, and as expected, it's risky. It's not it's not going to work. Sense. Whatever percentage you want to assign to the risk, 7 out of 10 startups fail. And from there, the kind of, swing for the fences home run, the percentages are even lower than that if you look at the base rate. And so what VCs do is take that risk and aggregate it together. Give the resources necessary to the entrepreneurs to go run after those opportunities. If it doesn't work, then it doesn't work. But when it does work, you can take the return from that power law distribution, the largest winners, and amortize that across all of the ones that didn't necessarily work out and have excess return on top of that. So that is, in a nutshell, why VC exists. And so your goal as a VC, or what a lot of VCs would describe as their goal, is to find those large winners. The line that I hear a lot is, you're never, and this is very much a difference, and I think the difference between, if you wanted me to say, like, down to one line, what is the difference between private equity of investments in private companies of any sort of scale and venture capital, is private equity, you might be judged more on the choices you make that don't work out, right? You make an investment in a company and that company fails. It doesn't hit the objective you thought it would hit on the front end. Venture capital is far more about making sure you don't miss the winners as opposed to avoiding the misses, if that makes sense.
Okay. So are most private equity firms, most companies that private equity firms invest in, are they mostly expected to make moderate returns? Is that kind of the game?
There's a lot of gray area in between of firms that operate in slightly different ways. But at a high level, private equity, you'll be shooting for some level of return and expect most of the companies in the portfolio, you'll have varying levels of return, but you're not really expecting companies to outright fail. You're expecting to make money on most of your investments in a balanced way across the entire portfolio.
Yeah.
A lot of VC firms, and it gets riskier the earlier stage you go, like at the seed stage, you're going to invest in 50, 75, 100 companies out of a given fund. And a lot of those won't make it to Series A, won't make it to Series B, let alone a successful exit.
Yeah.
But your your portfolio construction isn't reliant on that.
Okay. Got it. So would you say, I guess from the smallest side, smallest investments to the largest, we start with the seed and then Series A, Series B, etc. Where would you say venture capital and private equity firms fall into those stages?
It's interesting. I would say
And I know, as you said, they bounce around. Some of them have gray areas. Some of them will do one-off investments in weird companies. But yeah, just broadly speaking.
Yeah, so venture capital, you could draw the line anywhere. Series C, is still considered venture capital. Series D, Series E. As you go from seed to late stage / pre-IPO, think of it in that scale. The type of work that you're doing and the risk that you're taking on very much changes. You're not expecting, let's say, Series C and beyond. You're expecting those companies to continue to exist. There still is an element of some of those Series C companies will continue to break out even further. They will continue to accelerate their growth trajectory, and then some of them will not continue that aggressive growth trajectory that you typically look for in VC. They'll become nice, sustainable businesses and level off in a middle level, some outcome in the range of, call it 100 million to $1 billion of enterprise value. Where VC breaks off from private equity, it's funny. Back to your original question, VC is private equity technically. If you want to take the highest level definition of private equity, it's making investments into private companies. They're not public. They're not traded on any sort of exchange.
Okay, so we're looking at a rectangle's a square.
Yes,
squares are rectangles.
Squares and rectangles.
Got it.
VC is a subset of private equity. If you want to differentiate it from the other types of private equity that are out there, it really comes down to that portfolio construction and the reliance on, in a lot of ways, power law return distributions of one breakout company will often drive the vast majority of your returns.
All right, so next I'm going to ask you to defend venture capital for a second here. So I guess the complaint I've heard about VC in the past is that, yes, it's great that they pour, if they see one of those companies doing well, I'm expecting they'll probably pour more resources into it. Meanwhile, the other 90% of companies that they invest in don't get any attention, and they kind of expect those companies to flame out, which, again, from their perspective, totally makes sense. But from the companies that are looking to gain venture capital money, I guess, is there anything you could do to convince them that it's still worth taking the money?
Yeah, absolutely. I think and this is where I would really caution founders of thinking through whether taking VC money is worth it. Because now that I've walked through kind of the economics of the VC business model and how VCs are thinking about it, think of it from the founder's point of view. What are you looking for out of this relationship, and why would you accept this money if, thinking about it theoretically, oh, well, I took $10 million. Did I need that $10 million? Or could I have been a $10 billion company without the VC money? And if you could be a $10 billion company without the VC money, well, you just traded $1 billion of value for something that you didn't really need. So that would be a really bad deal. And true to form, we have seen cases where businesses will raise that money and they're already so successful that they never touch $1 of it from when they raise that round to when they IPO, become a successful business.
How does that work? Do they just give the money back?
No, they hold it on their balance sheet. It becomes part of the business.
So the VC firm still keeps their 20% or whatever they negotiated.
And you took the money, and you didn't really need the money. You're cash flow positive, and you never touch a dollar of it. It all stays in the bank. And if you're a really successful business and you're truly growing faster than you can spend money, then a lot of times that is the case, which is really funny to think about. And you think, why are these businesses still raising venture capital? There's a very real argument to be made that they shouldn't. But then you think about it. It's like, well, this person's creating a $10 billion company. They're not stupid. So what else is there? Right. And I think this dives into this really interesting idea of, why should VCs exist? VCs should exist if they're actually delivering on that promise and really helping these businesses exist where they otherwise wouldn't. And if you're a founder and you believe you can get there without either the money, the resources, the brand name, the introduction, then I would say don't take it. But really it's about thinking about the pieces of the pie at the end and who you traded a piece of the pie for and what value they really brought to the table. What VCs really need to deliver at the end of the day. It's either we are a commodity provider of, we're going to give you X dollars at X valuation for this piece of your company, and that's all we provide. We only provide capital. Or we're going to try to provide this, call it differentiated dollar, of we're going to bring something else to the table beyond just the capital that will increase the value of your business. I think depending on the type of founder, you'll get different preferences of, hey, I'm a first-time founder. I could really use the guidance to get to exit. Think about this gauntlet of fundraising rounds, hyper-scaling, hiring. There's just so much that you might need help with on a day-to-day basis. And then there's repeat founders who can look at it honestly and say, I've done this before. I know what the path entails, and I know the type of help that I'll need to get there again. And so in that case, maybe you don't need a differentiated dollar because the cost of that is going to be higher. You'd rather not take on that additional financing.
Yeah, that makes sense.
I'd think of it the same way. You're going to go buy a home. Do you want to take out a mortgage on that home? That's leverage that you're taking out on that purchase.
Comes with pros and cons.
Comes with pros and
terms
cons
and all that stuff as well.
Yeah, and it's like, okay, well, if I was going to take out a mortgage and the banker is going to help me pick out furniture for that home and do the landscaping, and it's a silly example, but like if you believe that banker is really